from that initial pop of almost 120 points, the Nifty has now come down to a gain of just about 70 odd points. The weak hands include the non-banks today, very interesting. Bajaj Finserv, Bajaj Finance, Jio Finance, Shriram Finance, HDFC Life. So the non-banking financials, they are the ones that are not too excited this morning. And then there are one or two other names like Tata Consumer and BEL. So that's where the slight sense of caution is in the market. But otherwise, I mean, it's not bad at all. Tech and consumer-facing, tech and global-facing names like metals doing really well. So JSW Steel, Infosys, these are the stocks that are retaining a bulk of their gains. And IndusInd Bank, unshaken, unstirred with this whole insider trading issue coming up. Because remember, it is, many of these five key management personnel, they've anyway been sort of moved out. They're no longer with the bank. So let's see. Market not too perturbed with the SEBI order that came in yesterday. That's about 1% on IndusInd Bank.
Okay, Som Distilleries, by the way, the numbers were fine, but the stock is now nosedived. It's down close to about 10 to 11%. And on the way up, buying has emerged in names like MMTC and India Pesticides. Good volumes, on these names and big moves on the way up. Well, that brings us, we're going to slip into a break on that note. On the other side is our special segment. It's The Economy. Lata will discuss the state of bond yields and banks in India with Ashish Gupta of Axis and Rikin Shah of IFL.
India's 10-year bond yield is at 6.7%. This is the lowest we have seen it since September 2021, 3.5-year low. The immediate trigger, of course, is the record 2.7 trillion rupee dividend from the Reserve Bank to the government, which is the largest historically, even if it is a little lower than street expectations. On the other hand, against the bond yields is the US 10-year yield. They have touched 4.5% this morning, after the court announcement setting aside the Trump tariffs, at least the reciprocal tariffs. The 30-year bond yield is at 5%, maybe even crossing the 5%, again, because of the court cancelling the Trump's reciprocal tariffs. The rise in US yields has led to foreign funds selling nearly $5 billion of Indian bonds in April and May. So what we are trying to understand today is where are Indian bond yields headed. There's a positive in terms of liquidity and a negative in terms of FPI sales. And what does all this mean to banks? I have with me Rikin Shah, the Senior Vice President of IIFL Capital, to talk about this and about banks in particular. In a bit, we will be joined by Ashish Gupta to speak to us about bond markets. Rikin, first to you, because we have a big banking event on our hands. Before I come to bond yields, I wanted to ask you about your views on IndusInd Bank. With the latest salvo from the SEBI, you have not seen much of a change in the bank's prices, but how would you approach the bank?
Hi, morning, Lata. So, IndusInd Bank, we know that there have been multiple frauds that have kind of been communicated to the market in the last couple of months. While the interim order passed by the SEBI does on the insider trading does implicate the ex-MD and CEO, given that they are no longer part of the system, we have not seen the stock price getting impacted by that. But focusing on the fundamentals per se, I think the near-term fundamentals appear challenging for the stock. the growth is likely to be very subdued given the liquidity constraint that they will be grappling with. The incremental funds that they are raising, they are still at 50, 70 basis points higher than what the other peers are raising at, and hence the margins will remain under pressure. And the path to a normalized 1% ROA seems a bit long drawn from the current moment. But while this is the fundamental, I think the next couple of months, the focus is likely to be on the new CEO name, which would be first communicated to the RBI and then subsequently appointed and approved by the RBI. So that's where the near-term focus is likely to be. And post that, we expect the stock to start behaving more, looking at how the fundamentals trend.
But is the worst in the price with this negative news? Does it become a buy?
Given that the next 1 to 2 months, the news flow is likely to be a bit more positive vis-a-vis what we saw in the last 3-4 months, do not expect a significant negative stock price action from the current levels. However, as I mentioned, post the CEO appointment happens, we expect the stock to start reflecting the fundamental trends, which we expect to be a bit more challenging still for the next 12 months.
Okay, now let me come to the overall banking space itself. We are seeing this fall in government bond yields. Wouldn't this be a challenge to banks in terms of their ability to, charge higher rates for, say, NBFCs or for any corporate, even for MSMEs? So do you expect, therefore, bank margins to be under pressure because of the fall in yields and because of the expected rate cuts?
Sure, Lata. So, we wrote a report recently where we said that the banking sector as a whole is ripe for a near-term breather. The essential argument underpinning this call is that given the rate cuts that we are likely to see, 50 bips have already happened, and the house view is that at least another 50 basis point will happen in this calendar year. The margins are likely to be under meaningful pressure. So we are expecting the margins to go down by 20-25 basis points in the next 3 quarters and subsequently recoup or stabilize thereafter from 4Q or FY27 onwards. The typical margin sensitivity says that for a 25 basis point of rate cut, you see margin pressures of around 5-7 basis point. And while the liquidity has improved and the cost of deposits, both on the savings account, time deposit, as well as the bulk account is going down, the full transmission of that will take a few quarters to play out. And hence we expect significant margin pressure for the large private banks in the near term, followed by the PSU banks. And the least impacted should be the mid-sized private banks who have higher share of fixed rate loans and hence lesser margin pressure vis-a-vis the other 2 categories.
Okay, got that. I'm just coming to you in a minute in terms of more nuances for banks, but let me invite Ashish Gupta, the Chief Investment Officer of Axis Mutual Fund, into the conversation. Good morning, Ashish. Thank you again for your time.
Good morning.
Well, I began by, triumphantly announcing that bond yields at 6.17% are a 3.5-year low. And this is even without the Reserve Bank rate cut. If the rate cut were to come, and given the liquidity, it looks like the call market will go even below the 5.75% that it now is. So, what is your view on US 10-year, on India 10-year yields and on the call yields over, say, the next 6 months?
Oh, I think I agree with you that RBI has taken significant steps, both in terms of the rate cuts they have done, but more importantly, the liquidity infusion that they have provided. And at the lower end, therefore, the effective easing is also not just the rate cut, but the corridor that has opened up between repo and the STF rate of 50 basis points. So I think the flow for the short-term rates is falling much more, almost about 50 basis points higher than the cut in rates. On the long end, on the 10-year, I think given the drop that we have already had, I think market is built in to a significant extent the rate cuts that are coming. We believe a large part of the 10-year rally is actually behind us. And what we will probably see is more steepening of the curve rather than a parallel shift down in the curve. So we actually expect the shorter rates to fall more than at the longer end, because at the long end, a lot of rate cuts have actually already been priced in.
Okay. Okay. So by the end, I mean, just to get an idea of how far the rate cuts and the liquidity can go, the government hasn't spent the money, the nearly 3 trillion rupees. That also will come into the banking system.
Yeah.
And looks like we have a much more bountiful monsoon than we expected, say, a couple of weeks ago. So are you looking at a 5-quarter repo? I mean, can repo rate cut go that far? And therefore, can call rate go even to 5%?
So our view is actually a rate cuts to be about 25 to 50 basis points from here. I know there are forecasts in the market that are calling for even larger rate cuts of about 75 basis points or so. But we have to be mindful that in addition to domestic factors, we have to be cognizant of how rates are globally. And globally, unfortunately, rates have not been coming down. And actually, if you see in the last 9 months, most major markets, whether you look at US, Germany, Japan, even Brazil, bond yields are up between 50 to 150 basis points, while in India, as we talked about earlier, at the long end, bond yields have come down by about 70 basis points. Having said that, as of now, the higher global bond yields is not really curtailing the room for the RBI, because the dollar index has actually been weakening despite rising yields. And that allows RBI to conduct its monetary policy looking at domestic inflation.
1 minute, Ashish. 1 minute, Ashish. We have seen $5 billion move out of Indian bonds in April and May. At some point, this might accelerate even more. We got, 40 billion or 20 billion in the last several months, in the last 18 months or so. If there is a very big legging out, do you think that caps the Reserve Bank's both liquidity and interest rate elbow room?
So actually, foreign ownership of the Indian bond market is not very material, right? Actually, foreign ownership in India is much more in the equity markets, both in the FII and FDI route. The good news is that over the last month and a half, we have seen foreign portfolio flows turning positive. And if you see, therefore, RBI has, despite the $5 billion of bond outflow that you mentioned, we have actually seen forex reserves again started getting accumulated. And we are again moving close to nearly $700 billion of forex reserve. So I think given that construct, RBI still has the elbow room to pursue its independent monetary policy. But I think it will also make them a bit more conservative on how aggressively they want to take down rates.
Okay, okay. Well, very quickly then, what's your view on, which is what I was discussing with Rikin, do you expect bank margins to take a fairly severe hit, considering that, the actual rates are lower than what the 10-year is indicating?
So I think, as Rikin also mentioned, there is no doubt bank margins will be under pressure. I think, having said that, the easing monetary policy was always expected to pull down bank margins. What has been a positive surprise over the last month is that banks have actually been willing to take a cut, particularly the private banks, in their savings deposit rate. And that actually protects the margins much more. compared to really the pace at which you take down the term deposit rates, because the repricing is immediate. I think what, in terms of stocks, will be an equally important indicator is how does credit growth respond to these lower rates and better liquidity. Because if you see last 2 years, even though bank margins were very strong and among the highest that they have had, the stocks had not done anything till about 6 months ago, because credit growth outlook was weakening. And I think it will be a positive for the banks if, on back of this surplus liquidity, sharp cut in interest rate, you see a rebound in loan growth. And if, say, we can go back from 10, 11% loan growth to 15, 16% loan growth, I think investors should be quite happy with that.
Well, at least there are two problems for that. The last IIP number we got is an 8-month low. The number that we got yesterday. It doesn't look like credit growth is really picking up. Rikin, your thoughts? Actually, two quick questions because we have to wind up out of time. What do you expect in terms of credit growth? It's not just margins, but looks like even credit growth is not very good. And therefore, the second question separately, should we stop looking at margins and start looking only at ROA when we pick banks?
Sure. So, in terms of the credit growth, the long 10, 20-year CAGR of banking system loan growth has typically been around 10, 11%. But what we had seen in the last couple of years, the system loan growth had accelerated to almost 16%. Now, since then, it has been steadily decelerating. And the latest fortnightly print shows that the banking system loan growth is down to around 10% YOY right now. And we expect this banking system loan growth to slightly pick up from current 10% level. But the view is that it's unlikely that it will go back to 15, 16%. The inherent reason for this softness in the credit growth in our view is twofold. First one is that the corporate capex cycle, first, it's not significantly or cyclically turning up, and whatever the funding requirement of corporates is largely being catered to by the bond market, ECBs, and to some extent some NBFCs. So the large banks have actually lost 25 percentage point of market share in the last decade. So the corporate demand and corporate loan growth is not coming. On the other hand, we have seen that some of the larger retail loan segments like housing loan, etc., we have done a study which shows that whenever the rates are cut, the loan growth in lower yielding segments like home loan also decelerate. So these are the two drags. On the other hand, we expect some pickup in the unsecured loan growth following the significant slowdown in last 1.5 years. And some MSME growth to be there. So from 10%, it can go up to 11, 12%, but unlikely to go back to 15, 16%. And margin, as we discussed earlier, is more of a cyclical pressure. We expect all of the margins that are being lost in this year to be recouped back in FY27. But ROA in FY26 is likely to go down by anywhere between 10 to 20 basis points. So investors will have to see through this cyclical pain and focus more on FY27 to be invested in the banks.
Okay. Actually, completely out of time. A one-line answer from you, Ashish. Would you also be as bearish on banks as Rikin is? ROA under pressure this year?
I agree with Rikin that ROA will be under pressure this year. I think ROAs will certainly come off from the highs of last year. But as he also mentioned, if we kind of take a more medium-term 2-3 year outlook, I think banks are still kind of quite comfortable.
Okay. Well, the audio is not obliging. Thank you very much, Ashish and Rikin. Get your point that there is possibly a cyclical low in terms of investor attraction for banks because of the lower ROAs, but medium term, it should be fine. We wrap up on Bazaar on that note. Short process coming.
Market opens mildly higher on expiry day but gives up gains. Global cues remain positive as US federal court strikes down Trump's reciprocal tariffs. The Nifty trades higher, led by metals and the IT sector. The broader markets in line with key indices.
Deepak Nitride rallies after a better than expected fourth quarter. The margins expand 150 basis points while the Finolex business drives revenue growth.
Max Financial Services revenues decline almost 2%, or rather the company's stock declines 2% after Axis Max Life Insurance MD and CEO Prashant Tripathi announces early retirement effective from the 30th of September.
Cummins India trades with solid gains on the back of its fourth quarter numbers. The revenue grows by close to 6% on a year-on-year basis. The company has also met its double-digit growth guidance for FY25. The con call is underway and the commentary is fairly optimistic.
Mishra Dhatu Nigam rises over 4% on steady fourth quarter numbers. The company's net profit jumps 21% year-on-year. Margins too expand 300 basis points.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. It's expiry day, and as we speak, though, Mangalam, the market's still trading with some green, though we've come off the high point of the day.
Yes, Nigel, it opened higher. The street expected there would be some supply because that's the zone from where we had seen some retreat, markets retreating earlier as well. That's exactly what took place. The question is whether we see a bounce from here or not. And if we do, then there could be a pop towards the last hour of trade, largely because of the shots that are there in the system for the market and the fact that there is May series settlement that takes place today. It's the Nifty Bank that has to move higher for the overall markets to move up as well. But we're talking about all things global economics. Eren Capiten, who is the chief economist at UBS Investment Bank, joins us from the sidelines of the UBS Asian Investment Conference. Thanks a lot for joining in, Eren. It was a pleasure speaking with you. Speaking about the global economic outlook, and I look at your forecasts as well, I just wanted to understand what proportion of your growth estimates are contingent upon US-China or the global tariff uncertainty, because there's so much back and forth out here. What weightage have you accorded to these in your model? And how much of this is agnostic of what transpires in global trade?
Yeah, the short answer is all of it's conditional on what happens on the tariffs, to be honest. So now, related to tariffs, there's other things like, uncertainty. You could argue that not all of the uncertainty is related to the tariffs, but it's really all about the tariffs. So had we not put the tariffs into our forecasts, we wouldn't be forecasting global growth at 2.7. We'd probably be much closer to the levels that we had last year, which were a little bit above 3.
So the reason why I ask you this is because, it is so back and forth. There is a certain number today, there is a certain number tomorrow, and then day after tomorrow, chances are that there is no number. How does one then account for all of these?
Yeah, no, exactly. So we've adopted the approach that we will mark to market whatever tariffs are in place. We're filming this on the 29th, and we just had this court ruling that basically has vacated all the tariffs.
Exactly.
It doesn't vacate, of course, some of the sectoral investigations. So the auto and steel tariffs, those are still there, but we'll now have to see what happens. There's 10 days to appeal the court ruling, so we'll have to see whether these tariffs actually get removed or not. My guess is that even if they do get removed, then the administration will find another legal authority to try to put them back in place. But where we stand today is that the U.S. has imposed roughly 1.5% of GDP worth of tariffs. Back at the peak before the China de-escalation, it was about 2.5% of GDP. But as you say, it keeps moving around, right? This threat against the EU, that's another 0.5% of GDP. So we just keep changing our numbers, and I think today's good news, right? So there's the hope now that maybe these numbers come down, but I think we'll wait to see the appeals ruling before we change our numbers.
We've heard of economists, we've heard of hedge fund traders mark to market, we've heard of long-term investors not mark to market, but here we have economists marking to market as well. That's the world that we're in, Nigel.
Well, that's right. Hi, Arvind. Good to see you on the show, and thanks a lot for joining in. This is Nigel on this side. The world was focusing on MAGA, that's Make America Great Again, and suddenly this morning we're waking up to taco. That is Trump, again, chickened out. He says no, but let's hope there's some rationality that does play out, and in fact, it'll be a better place, in the global front as well. But Arvind, from an India market perspective, we have plenty going for us, right? We have crude oil prices that are lower. We have a rupee that's fairly stable, good leadership as well. The problem for us is the globe, because the globe is in a tizzy and plenty of uncertainty, with central banks as well being fairly uncertain of being fairly flimsical. What are you assuming with regard to the India growth story? And do you think there are enough tailwinds for us to continue to growing?
So India is in a relatively better place just because it's more closed than most economies, right? So I think in Asia, the countries that are sort of relatively immune to all this tariff uncertainty and the drag from global trade are India, Indonesia, really the large sort of more closed economies. But there's also a silver lining, I think, for India. Like if these tariffs were to actually be implemented, and particularly if the tariffs on China are very high, then India is potentially one of the big beneficiaries. Now, that's more, I think, medium term as the Chinese trade surplus gets redistributed across the region. In the near term, I think what's playing out is just sort of a very disinflationary dynamic. So everyone's growth is a little bit lower, right? So we're feeling the pain of the reduction in trade, the lower growth in China, Europe, the US, right? So that hurts everyone. But there's also a disinflationary impulse because outside of the US, these tariffs really are not inflationary if you don't respond to them. If you don't raise tariffs, it's not inflationary. And so that's opening the door for significantly more rate cuts. And so one of the places where we think there is basically scope to cut more is India.
Right. In your report, you've written that as long as orders don't turn around, it is unlikely that we see a turn in global trade and production, which have been depressed for the last 2 years. And at the same time, you've written that there is no stimulus coming in from any government in the world apart from China, which is about 2% of their GDP. What, according to you, will drive global growth from here on? And what should really happen? Because even the labor force participation is now back normalized.
Yeah, so I mean that's on the fiscal stimulus. So I do think we get globally some monetary stimulus, but you're right. So fiscally, I think there's not a whole lot that is moving, and so so we do. We think in the next sort of 4 quarters we do have a slowdown. It's very difficult to offset that if no one is actually providing any kind of fiscal stimulus, but it's very much a slowdown concentrated in the net export sector. So if you look at the domestic demand dynamics, they are generally a lot healthier than I think the export dynamics, and so that part of the economy is generally a little bit more shielded. But it'll take until the middle of next year before we sort of start to climb out of this uncertainty and this tariff shock. So we call that a deadweight loss. It's basically a level shift lower in the global economy, and then eventually we'll go back to the old growth trajectory.
All right, Arvind, what about this US deficit and the debt? That's clearly worrying, right? What kind of numbers are you assuming? And could the administration, the United States, find some kind of a way out? Because you have yields that are spiking, which is clearly a sign of caution.
Yeah, so we're on a clearly unsustainable trajectory. We even with the bill that's now come out of the House, we're looking at a deficit that's still going to be in excess of 6% of GDP. That's including the tariff revenue. If it's excluding tariffs, then it's about 6.5. That means the debt's going up by 3 percentage points of GDP per year. That is faster than any other country that we have under our coverage. But it still means that it's going to take another 10 years before the U.S. overtakes Italy, which is trading at a lower yield, right? So yes, we're on an unsustainable trajectory. It's not yet clear that automatically then should translate into a significant repricing of the debt. Now, the fact that that's happening is partly because it's getting mixed in with, I think, all the other reasons people want to be reducing their U.S. positions, which is the policy uncertainty, some of the erratic decisions that are being made. I think that global investors came into the year with too much U.S. exposure. And so that unwind is sort of getting mixed in, I think, a little bit with the long-term sort of debt sustainability concerns. The one thing I'd say is because there's sort of a common narrative that the backup in long end yields that we've seen in the U.S. is related to this rotation of foreign investors away from the U.S. in the last couple of weeks. That is actually not the case, and the U.S. Treasury puts out numbers every few weeks about what is the foreign demand for their debt. And the interesting thing is that it's not the foreign demand that's fallen off; it's to some extent the domestic demand that's fallen off.
That's an interesting point that you make out there. So foreign demand for US debt is still fairly steady. Then, the simple question and perhaps a not so simple answer to this would be, what happens? What has to happen for, all of this to turn around and for us to come up? Because from where we see right now, there is a fair amount of fog on the windscreen.
Yeah, so I think that's one of the things we struggle with, right? So even if you remove all the tariffs, the question is, have you removed all the uncertainties? So if you look at, for instance, US and Eurozone uncertainty indices, then there are about 4 standard deviations above a long run average. Now that is so far above normal that, and if you run, we call this impulse response functions. If you basically try to estimate how much that is worth in terms of the growth drag, that is more than the entire forecast revision that all the banks have made for the global economy. So it's very, very significant. So if you're a corporate and these tariffs are now removed, the question is then, how certain are you that the U.S. administration is not going to try to reimpose those tariffs? Is it really the case that you can now place 100% of the order that you had been delaying? And so I think there's some lasting damage here based on what's happened the last sort of 3-4 months, even if the tariffs now get taken down by this court ruling.
All right, Arvind, we've been hearing Mr. Trump talk about drill, baby, drill. I'm wondering whether he's going to start pushing for print, baby, print. What are you factoring in with regard to the Fed action from here on? Could they go ahead and cut rate cuts? Because even the last year, we were factoring in far number of rate cuts, but by the end of the year, they were much lower. And for this year now, there is some question mark on whether or not you're even going to get a couple of rate cuts. What are you factoring in?
Yeah, so I mean, fortunately, he doesn't control the Fed, right? So,
yeah, that's good.
And the court ruling we had, I think, last week was very significant, right? So the Fed's independence seemed to be explicitly sort of mentioned as being separate from some of these other regulatory agencies. But so we think, our view is that the Fed is going to, if these tariffs do go ahead and you get unemployment starting to increase, then even if there's inflation, their reaction function will be to try to ease into that. And the reason is that the level of the Fed funds rates is still in restrictive territory. So they will basically want to get to something that is much closer to neutral. So we have about 100 basis points in cuts penned in for the second half of the year. But that is really conditional on seeing the labor market start to weaken. We haven't seen that yet. And so if we do not see labor markets weakening and we do see some of the inflation pressure come through, then I think they're stuck and they probably stay where they are. But I think their inherent bias here is to want to get to slightly less restrictive territory if you have tariffs that are basically doing all the slowing of the economy for you.
Right. Final question before we let you go around. I think the crux of your report, one of the most interesting things was the vacancy to unemployment ratio. What does that tell you about where we're likely to go from here?
So vacancy to unemployment ratios are coming down all over the world, and they've actually been coming down pretty rapidly in the US, but they're more or less back at 2019 levels. So, and those were still very, very tight labor markets. So the starting point is actually quite healthy, I think, going into this sort of potential growth shock or this tariff shock. So labor markets are tight. I think that's holding up demand. But from these levels, I think we are going to see that vacancy to unemployment continue to go down. If you remove demand and everyone is growing below potential growth, then we're going to start to see unemployment creep up. And that's basically in the forecast for the next sort of 6 months to 12 months.
And if you had to, deploy $100 in a portfolio for the next 6 to 12 months, how would you distribute that across asset classes and geographies?
So right now, if it were me personally, I would be, you can go back to what happened in 2018 and 19. In 2018, the best performing asset was actually just to stay in the sideline and be in cash or in gold and stay away from the risk assets. And then in 2019, you had to do the reverse, right? And so there's basically an issue here of when is all the bad news priced? And until that happens and you have clarity about where the tariffs settle, you want to be incredibly defensive. And for us, that means being effectively trying to be long fixed income, maybe not in the US, but certainly we have about a basket of emerging markets, some of the European countries. You try to sort of stay a little bit in the assets that sort of benefit from lower growth. So that's fixed income, golds. Stay away from equity effects. But then as we sort of price the news and we start to get some easing, then you rotate back into some of the risk assets, which will be equity. Credit, I think, is too early, hasn't really repriced yet. And then geographically, I think right now you largely want to stay away a little bit from the US. So we're sort of neutral US, and we're basically overweight some of the European countries and some very select emerging markets. But in general, I think it's a bit too early to be long equity here, even with today's headlines.
Incredible. Thank you so much, Ren, for joining in. Wish you a good conference and maybe a lot of insights emerge from that as well, and perhaps some clarity over the next couple of weeks as well. Take a short break, come back. We focus on the micros, the stock-specific action with Sachidanand, taker of Trade Bulls. virtually unchanged for the market right now. So good time to get in a quick view on where we're likely to go from here. Sachidanand Taker of Trade Bulls joins in now. Sachi, the Nifty's petered out all the gains that we saw at the open. Right now, absolutely flat. What would your trade on the indices and individual stocks be quickly?
Good morning, Mangalam. Clearly, I think the view on the market remains sideways. Even yesterday, for the last two trading sessions, we have been maintaining this particular view that it is ideal to, build some long positions on a decline, but the support is placed somewhere close to around 24,630, where its 5-day exponential moving average is placed. And on the higher side, we need a decisive close above that 24,830 to unlock that move towards 25,000. So overall, the structure is bullish, but we are locked into a range-bound, mode. And probably, one should wait for the decline to deploy some long positions. The best position, the best level would be close to that 5-day exponential moving average, which is placed at 24,630, or on a breakout about 24,830 itself. So when we look at Nifty Bank, it's a very similar, data set. 55,000 remains as a very strong support, but on the higher side, we need a closing above 55,540. After that, we may see some directional up move. So as of now, for the day, I think it's better to wait and wait for the decline to extend. And probably 24,630 would be an ideal level wherein some contra longs on the Nifty can be deployed.
Okay, all right. Hi, Sachi. What about individual stocks? What are you looking at?
Nigel, I'm liking MGL. The stock has maintained a strong range throughout this particular series. We have seen good support at around 1300, 1320 levels. It has again displayed a good rebound. We're expecting that this particular rally may continue towards 1440, and eventually we may see an extended move towards 1475 in the coming series. And that's why we are recommending building long positions in MGL, keeping a stop loss at 1370. And intraday, a positional target would be placed at around 1440. The second stock on our radar is Trent Limited. Again, here, if you look at the overall structure, the stock is challenging its 200-day exponential moving average. What we expect is that there could be a breakout soon in this particular counter, looking at the way the trend state indicators are placed. So we are expecting a rally towards 5830, and that's why we are recommending building long positions with a stop loss at 5560.
All right, Sachi, thanks a lot for that. Let's get you some ideas for profit coming in from our colleagues at Money Control Pro now. We have Varsha Bang, who's joining in with a stock that she's been tracking. Varsha.
Bazaar Style, an emerging player in India's value fashion retail segment, operates under the Style Bazaar brand and has expanded rapidly since its inception 2013. With 2014 stores across 170 cities, the company focuses on Tier 2, 3 and 4 markets, especially in East India, benefiting from a cluster-based expansion model that enhances operational efficiency and market penetration. A key growth driver is its private label offerings such as Square Up and Avia, which contributed 44% of revenue, expected to increase 60% by FY27, enhancing margins and profitability. In FY25, Bazaar Style recorded a strong 12.8% same-store sales growth, driven by increasing footfalls and larger basket size. The company's family-centric approach and localized merchandising have fostered strong customer loyalty with 73% repeat customer rate. Looking ahead, Bazaar Style is strategically positioned to tap into the rapid growth of Indians' value fashion market, particularly in the under-penetrated regions. With plans to open 40-50 new stores and expected revenue growth of 20 to 25% annually over FY26-27, it represents an attractive investment opportunity.
Thanks a lot for that, Varsha. Well, time to slip into a short break. As we do that, we are excited to unveil our brand new global business news channel, the all-new CNBC TV 18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV 18 Prime decodes global shifts and their impact on India businesses, giving you unparalleled insights. Tune in to CNBC TV 18 Prime at 12 noon for the Global Reset and the Global Lens at 8:30 p.m. Welcome back. Markets as flat as can be, but let's tell you about a few stocks that are moving around in today's trading session. Avanti Feeds, that's surging after reporting a solid set of numbers. Ria joins us to decode that set. Ria?
Well, good morning. Let's take a look at how the numbers have panned out for Avanti Feeds in this quarter. For quarter 4, they've seen good growth in the overall revenue, up around 8% over the previous year. Very strong improvement on the profitability front as well. For quarter 4, EBITDA and net profit have jumped up by around 26% and 39% respectively. Even on a full year basis, EBITDA and net profit are up around 38% and 51% respectively on a year-on-year basis. Quarter 4 EBITDA margins have also seen a jump of around 267 basis points, with the full year margins going up by around 200 basis points compared to the previous year. Coming to the segments of the company, for the shrimp feed revenues for FY25, remember this constitutes around 78% of the total revenues. For this segment, the revenues have increased marginally, just about 3% over the previous year, but the EBIT margins have seen a very sharp jump up of around 500 basis points compared to the previous year. For the processed shrimp segment, though, this contributes around 21% of the total revenue. For this segment, the revenues have gone up by around 9%, but on the margin front, we've seen a very sharp decline of around 500 basis points over the previous year. And remember, the margins have been under pressure over the last year because of increased freight costs, higher raw material costs as well, and even the higher countervailing duties imposed by the US have caused some margin pressure for this segment. So this is one segment where the company has underperformed, but largely the results look very strong for Avanti Feeds, which is why the stock is trading higher today.
Take that point, Ria. Thanks a lot for that. Meanwhile, just watch out for Cummins. That stock is now surging up around 6%. The conference call is currently underway. We are, getting some positive commentary coming in. They said that they will continue their capex in the same range as FY25. But more importantly, what they're expecting to see is maintain their gross margins for FY26 and look at some growth as well for the next year. What we'll do is we'll at some point get in Vamakshi to give us a roundup of all the key takeaways from the conference call. Currently, the street likes what the management is saying. The other one is Deepak Nitrite on the back of good numbers. Remember, their conference call starts at around 12 today, so we'll have our team listening into that as well. And finally, we have Strides Pharma, which too has surged to the high point of trade. So even as the frontline indices are consolidating, a lot of individual stocks clocking in big gains. Take a short break, come back. On the other side, we have the team of Trading Hour taking the next hour of trade forward.
Hello, good morning. You've tuned into Trading Hour, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala, and with me is Hormaz Patak as well. Hormaz, very good morning to you. We were expecting a better morning so far even now, but let's not forget it's Nifty expiry as well, monthly expiry. So volatility is the name of the game, and today taco, that's the name of the game as well. I hope we do get some tacos to eat as well is what I'm watching out for.
I just asked the PCR for some tacos if we can.
By the end of the show, I hope we're getting that then. But today, Nifty flip-flopping between the red and the green, 24,750 as of.
Blame it on the expiry, right? And that's what has been happening. Even the good news is not being appreciated here by the street. We did open higher though, but we have come off significantly from the highs of the day, almost giving up all the gains that we have had. And this despite the Dow futures trading with gains of 600 points as we speak. So the Wall Street is cheering the announcements that were made by the US Trade Court overnight, but that is not being reflected in our own markets. Of course, banks are the principal culprits here, 150 points down on the Nifty Bank. So that is also weighing in on the sentiments. And as you can see some flashes on your screen, the RBI has released its annual report for FY25. We'll get you more details on that as well over the course of the show. But for now, the index has given up the gains. The broader markets too have given up their gains from the morning. So it's a fairly choppy start to the trading session. And of course, you can't not ignore the earnings reactions that are coming in today. Welspun Corp among the top gainers on the Nifty 500, 8.5% higher on that stock after a strong result performance coming in for the fourth quarter. And MMTC too, 12% higher, building on to gains from yesterday, mind you. So 12% higher on MMTC. That's doing fairly well for itself as well. So good going for some of these earnings names. But the stock of the morning that we've been speaking about, and it was a big development that came in last evening, and that is IndusInd Bank. And that is after the Securities and Exchange Board of India, or the market regulator SEBI, has passed an interim order in the high-profile insider trading case involving key managerial personnel of the lender, including the bank's former CEO and other senior executives. Now, the regulator has barred all of these 5 individuals from buying or selling securities and has also frozen their bank accounts. Ritu is here to give us more details on this. Ritu.
Well, Hormaz, as you said, it is a damning order, against the 5 senior executives, and that includes the former CEO Sumant Katpalia and former Deputy CEO Arun Khurana in this insider trading case. The regulators found essentially that these individuals sold shares of the bank while they were in possession of unpublished price-sensitive information and thereby avoided losses of nearly 20 crore rupees. In this interim order, SEBI has frozen their bank and demat accounts to the extent of those gains. It has barred them from trading in securities until further notice and asked them to submit a full inventory of all of their assets. Collectively, the order shows that these individuals avoided losses of 19.78 crore rupees, out of which 14.4 crores was by Arun Khurana alone and about 5.2 crores by Sumant Katpalia. The others that have been named in this order for alleged insider trading are Sushant Saurabh, who is the head of Treasury Operations, Rohan Jatanna, the Senior Vice President of Global Markets, and picture this, Anil Rao, the Chief Administrative Officer, who is also part of the 2-member executive committee approved by the RBI, currently running the bank in the absence of a new CEO. Now, SEBI's investigation shows that these people were aware of the discrepancies a good 15 months before they made this disclosure. And not only their internal team, even the external auditor KPMG had flagged this impact long before. Sumant Katpalia, for instance, he alone sold about 1.25 lakh shares of IndusInd, while Arun Khurana offloaded 3.5 lakh shares without making a single new share purchase in the period between December of 2023, that is when the management first found out about the discrepancies, and March of 2025 when the information was made public. Now, beyond these 5 executives, SEBI said it is still investigating other suspects that it did not name. So, questions are already, of course, swirling around the board's oversight, the auditor's role, and importantly, Anil Rao being part of the 2-member executive committee, whether we will see that committee getting revamped and the repercussions that he would have to face. Now, with the CEO and the deputy CEO already out of the picture, the story is still far from over and more heads may roll if the insider trading charges stick.
Okay, Ritu, thank you so much for that. And on that note, we had Amit Tandon earlier on the day as well. And he was talking about these issues coming in and discussing more on, the IndusInd prospect going forward as well, especially after this order that has come in. Listen to that conversation.
If you read what SEBI said, SEBI said that, look, we've appointed KPMG on the basis of a board note. So again, you have to ask whether the board were shielding the management or whether they were taken by surprise. I think that is really not clear at this stage, and we'll need to hear a little bit more. So if there is action against the board, you can expect that there is going to be some more tumultuous times going ahead. It's clear that the board has not lived up to what RBI's expectations were and what the investors' expectations were. So I think we are going to be in for some amount of volatility or internal churn as far as the bank is concerned. Likely to be a shakeout as far as the board is concerned. There is, of course, the existing board structure, existing management structure or the leadership structure will change. So the question is, how quickly will they be able to bring in a new CEO? And that in itself will mean there's going to be a round of internal cleaning up. Every bank is going to become much, much more internal focused rather than looking at opportunities out in the market. So I think there's going to be some degree of slowdown as far as these bank operations are concerned.
So important conversation there on IndusInd Bank. The stock though has not seen much of a reaction to that, and it's almost a hope trade now that the clean out process has begun, things will start to normalize for IndusInd Bank, and it's showing up on the screen as well, 1.25% higher for IndusInd Bank. The stock is now up 35% from its 52-week low of 566 that the stock had fallen to, or 606, I beg your pardon, that the stock had fallen to after the first instance of the derivative accounting issue had come out. So IndusInd Bank there for you. By the way, the flashes of the RBI annual report on your screen. The global economic outlook for 2025 and 26 remains clouded by multiple challenges. The RBI annual report also talks of the fact that there are elevated debt, public debt across several economies, and that has been a subject of the conversation as well, particularly in the US. The pace of disinflation is losing momentum. Challenges also include trade tensions, financial market volatility, climate shocks. So a lot of issues being addressed in the RBI annual report. We'll talk more about this as the show goes by as well. But from the broader markets, the earnings reactions continue. As we just mentioned earlier, Insecticides India and Bharat Rasayan are two of them, and both of them are seeing reactions at the opposite ends of the spectrum. Rhea has the fine print for both of these shares. Rhea.
We've got two earnings candidates in focus today, both Insecticides India and Bharat Rasayan. First, focusing on Insecticides India, the revenue growth has come in at around 2% for FY25, below the guided range of 3 to 4%, with a volume growth at around 10% and a price decline of 8% in this year. EBITDA margins, however, have remained strong at around 11%, in line with the company's guidance of double-digit margins. Gross margins have also seen a jump up of around 650 basis points in this year, which was led by a better product mix, improved pricing strategy, and as well as the new launches that were taken by the company this year. Overall, the profit growth has been led by an increased focus on the value-added premium products, which have seen a growth of around 13% in this year. Going forward, the company has said that their growth outlook remains intact. They're expecting an expansion in the premium products, stable gross profit margins, as well as a further improvement in the EBITDA margins as well. For the newly launched herbicide called Altair, they are expecting to generate around 10 to 15 crores of revenue initially, with the revenue going up to around 40 to 50 crores in the subsequent year as well. So overall, healthy set for Insecticides India, and the street is reacting positively to that. On the flip side, Bharat Rasayan has posted a very weak set of numbers in this quarter. The full year performance though has remained largely healthy, but quarter 4 has disappointed by a lot. Revenue growth has remained flat in this quarter. Profitability has been sharply lower. EBITDA and net profit have seen declines of around 42% and 62% respectively, both on a year-on-year basis. And margins, EBITDA margins, have also seen a very steep cut of around 925 basis points. So the street has been reacting negatively to that. Stock down around 8% on the back of this.
Thank you so much for that, Priya. But a quick look at what these other stocks are doing in today's trading session. We have Zentek, that's coming back in action as well. As of now, is up 5% in the trading session. Obviously, this is one of those companies that makes drones, and during the run-up that we saw in the defense stock, Zentek was one of them that saw a run-up. ITI Limited, they reported their numbers, and yesterday we had already seen a run-up. Today also that's continued, so surely good set of numbers from ITI is keeping the stock abuzz. Let's also look at
Castrol India, that's buzzing in trade today, 5% gain on that front. Vari Energies are some of the gainers that are coming in. And other than that, overall from the broader end of the market, we're seeing a lot more performance coming in because of the earnings reaction that we're seeing for some of the companies. And Ria mentioned a few of them as well. But let's talk about Cummins India, because that's also buzzing away in trade, almost trading at the day's highest point. And this is after its Q4 numbers, but also commentary came in from their con call that was just there a short while ago. Vamakshi is joining in with us to give us the latest on this front. Vamakshi, what were the key highlights coming in from the earnings as well as the con call?
Well, absolutely. When it was a good set of numbers that came through from the company. Of course, revenue came in much lower as compared to what the street was expecting, largely led by the miss on the domestic front, but the exports business for the company did quite well. They saw an uptick of almost 39% on a year-on-year basis. Largely, when you look at the operational numbers, they came in much better than anticipated. Keep in mind that in the same quarter last year, there was a one-time gain. Therefore, the margins looked higher last year, and we were expecting a significant contraction this time around in the margins, but that has not really panned out. The contraction in margins is not as worse as one would have expected. The net profit, though, has seen a downtick of almost 7%, and largely this is the number for the net profit has come in much better than what the street was anticipating. The con call actually just concluded just a couple of minutes ago, and the management said that they are anticipating double-digit revenue growth to continue in FY26 as well. They endeavor to sustain as well as slightly improve the margins. This is the gross margins that I'm talking about in FY26. However, they are cautiously optimistic on their demand outlook. Keep in mind that they have said that the pricing could take 1 to 2 quarters to settle completely, and the competitive intensity out here has picked up, but largely they have been able to hold on to their prices, which bodes well from a margin perspective. Capex will be in the same range as seen in FY25. So largely those were some of the important takeaways that have come through from the con call. Resultantly, the stock is trading higher.
Well, the street likes what the management has said in the earnings call. The stock had surged to the highest point of the day at Cummins India, almost 6% higher now on the stock. Vamakshi, thanks a lot for that. By the way, the index has cooled off further from the highs of the day, but we take a short break. On the other side, we get you all things commodities with Manisha Gupta. Welcome back. Well, the index has cooled off significantly from the highs of the day, and now it's into the red. Now 20 points down on the Sensex at 24,730 now is where we stand, and that is in comparison to the highs of the day of 24,889. So almost 160 point downtick from the highs of the day is what the Nifty has seen. The monthly expiry for the index today, and that seems to be weighing in on the sentiments on Dalal Street as of now, because the Dow futures continue to remain where they are, 600 points higher for the Dow futures. The US dollar has staged a rebound. It's above the mark of 100. Crude oil prices too have seen a rebound. Brent is now heading towards $66 a barrel. We'll talk more about that as the day goes by. But on to earnings conversations. Then GIC RE reported its fourth quarter numbers, and we are now being joined joined by Mr. Ramaswamy Narayanan, who is the chairman and managing director at the company. Mr. Narayanan, good morning. Thank you so much for joining in. Your gross premiums for the quarter grew by 10% and your net earned premiums were also up 9%. What are you penciling in for FY26 when it comes to both these aspects, both the gross premium and the net earned premium as well?
So typically we would be looking for about 10% growth going forward, and simply because we are planning to grow both our domestic and international business. The international business for last year actually we had degrown, and honestly in the last maybe 2-3 years we have been kind of consolidating our book. Our growth journey started last year. Last year we grew by about 10.72% year on year. So last year in October we got our credit rating upgraded. We, for writing international business, you need to have a good international credit rating. So currently AM Best has rated us A- excellent, which allows us to really renewed. We grew there by about 8%. So overall, we expect to grow by about 10% in this year.
Right, sir. Good morning. This is Vinny joining in the conversation as well. What I want to also understand is in terms of your underwriting loss. There's a loss this time of around 224 crore rupees in Q4 versus a profit of 490 crores. What has led to that? One, is that a one-off that is coming in, or maybe possible that this could see an impact in Q1, Q2 as well?
Vinny, hi, good morning. This good, some do not look so good. So coming back to our performance, if I were to look at it from an annual perspective, we've actually done very well. Last year around the same time in April, when people had asked me what we were proposing to do, I said after 3 years of consolidation, we are growing now. So we would grow 10%, but actually we have done better. We've grown by about 10.72% for 24-25. We also said that we will be striving to remove or shave off 2% from our combined ratio every year. Now this year we have actually done better. We have shaved off 3%. From 111 we have come down to 108, and our loss ratios have come down by 4%. Our profit before tax is at 8,650 crores, which is a record for this company. In its 53 years, it has never touched this kind of figures. So we are very sanguine about what we are doing, the underwriting that we are doing, and how we are essentially trying to ensure that the business that we are writing are profitable. Coming back to your question about Q4, what happened there? Simple. We write international business. So obviously we also write